Hey everyone, sorry about the problems. You, Neither Sergio nor I could figure out what was going on. But I welcome you aboard, and everyone's coming back into the room, and I really appreciate it because I think this is going to be a real helpful webinar in understanding oscillators and how to trade them. This is Mark, by the way, from Right Line Trading. And some of what I'm going to tell you is if you came into the first webinar, it's going to be a little bit redundant, but I'm going to try to take it a lot further and go a little more in depth so that I think you're going to understand how to use an oscillator a lot better and understanding the kind of metrics that it's assessing and the way that we can use them to help us trade. So let me just go to the first slide. And obviously, it's the quick disclaimer that all trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational demonstration purposes only. Right Line takes no responsibility for any participation by visitors or subscribers when the futures or forex markets for any profits or losses. Trading is risky. It's not for everyone. You can lose a substantial amount of money. Never risk more than 2% of your account on any trade. Right Line Trading is not a registered financial advisor and not a licensed commodity trading advisor. Now, with that said, we're going to talk about oscillators in general first. And I mentioned in the previous webinar about George Lane. And what George Lane wanted to create was a novel momentum-based indicator, and he really did an amazing job when he created stochastic. And I look back on the date, and the date is in the late 50s. So he created this oscillator long before there was any kind of sophisticated charting program. And to me, it's really a mystery as to how he did it, because he really only had crude tools to use. But I believe that his theory was really correct, and that momentum being a second order derivation changes before price changes. So that what he was really looking at was a metric that was forward looking. By simply analyzing the price on your chart and looking at the change in the momentum of price, he could predict how price was going to move out into the future. And it's really clever how he did it. And I'm going to show you a little bit about momentum derivations. And you can see that I think that what he was onto at the time was absolutely correct. So any oscillator, not just the stochastic oscillator, but the stochastic oscillator, the one he developed, could be used to foreshadow reversals. And again, as I mentioned, he used the tool exclusively to predict bearish or bullish divergence. He did not use this as a trend finding tool. He simply looked for divergences in overbought and oversold areas. And he believed that that was a very, very precise signal. And he also said it was the most important trading signal that had been identified to date. Now, at the time, I really do believe he was right. We can't do a look-back analysis of what was going on in the late 1950s. I mean, I was alive, but I would imagine a lot of people out there weren't. And the tools to track this were just not even available. Just remember that momentum measures rate of change. And rate of change is really a second-order derivation. And a second-order derivation is going to change before the first order parameter that is used to create it changes. So really what he was looking at was the faster as the price of a stock moves up faster and faster, it accumulates momentum. And then as it continues to rise, if it doesn't continue to move up quite so fast, momentum is then going to start to fall. And eventually, the stock is going to fall. So momentum will wane first, and then later the price will collapse. And that's what he was looking for with divergence. Now, before we get to here, I want to just go to paint and show you something that I've created here. And this is just a graph. And this is a graph of speed, and this is a graph of momentum. Now, this exactly is going to mimic what happens to the price in a trading instrument. But we're going to do it, we're going to make the analogy, because I think it's a little bit easier to understand, with a race car. Now, if a race car is moving around a track, I'm just going to go to the drawing tool here for this, and it's moving at a constant speed like this. So the distance it covers per every unit of time, or the slope is constant, then what's going to happen with momentum? It's going to flatten. And essentially, once it hits a certain level here, momentum will be flat. So a stock that rises at a constant price obviously has momentum, but that momentum isn't changing. And the equation is related to momentum equals mass times velocity. And as velocity increases, momentum increases. Now let's get rid of the lines and take another scenario. I love this. I like this eraser. Now, if that same race car is moving across the track at ever increasing speed, because now the distance it covers per unit time is getting greater and greater, now momentum is going to rise like this. And you're going to get ever increasing momentum. Now, here's the scenario that George Lane was looking for. I have to go back to the eraser one more time. He was looking for the scenario where the speed starts off fast, but then flattens. I didn't make that very, very well, but it starts off geometrically and then flattens to an arithmetric curve like that. And then the speed just becomes constant like this. So the price of a stock starts to move up rapidly. And then the price continues to rise, but it starts to rise at a constant rate. The slope is there, but it's just minimal. So it's always moving up, but it's moving up minimally. So what you would start is with momentum starting up like that, and then flattening out like this. And what he believed was that this deceleration in speed heralded a drop-off in speed. Now, if speed dropped off, you would still, I have to make this better because this is a tougher curve to make. As long as you have positive speed, distance is going to continue to rise. So as long as the stock is moving up, you're good. And curve number one can never be negative. You can't go backwards in this scenario. All you can do is potentially slow down and slow down and slow down. So first you get this rapid increase like this. Then speed moves at a constant rate. And then it flattens out almost imperceptibly and it just moves constant. Now, that would create a momentum curve like this, and then it would flatten like that. And he believed that in price, that would herald a reversal in speed, and distance would then start moving back to the starting gate. So what I'm trying to have you understand is that he believed that momentum changed before price, which is equivalent to speed. During this course, where price was moving up geometrically, momentum was moving up geometrically. Then when price started moving up at a constant rate, momentum flattened. And that heralded an eventual diminution in speed, and therefore a drop in momentum. Now, his theory was that you could continue to move forward like this, but as you moved forward at a lower and lower pace, momentum actually became negative. And I hope everyone understands that. So if you start off, and I'm going to change the color, if you start off moving extremely fast, and your momentum is really kicking up, and then you start going constant like this, momentum becomes constant because momentum equals mass times velocity, and you still have velocity. But once the momentum flattens out, it heralds ultimately a fall. So while price is still moving up at a constant rate, momentum has already flattened out. I mean, it's a forward-looking parameter, and it's telling you that eventually you're running out of steam here, and ultimately this is going to fall. Now, divergence is just simply price coming back at a lower speed to create a lower momentum value. And we'll look at that. I hope I didn't confuse you, except you can look at speed as X hold on a second here. And you can look at momentum as X squared. As a second order derivative. So let me move the slides back. So I think he really had the right idea when he said that momentum changes are going to come before changes in price. Let me just get to the presentation. Not being a mathematician, that may have not, a mathematician probably could have made that a little bit clearer than I did. But I hope you understand that changes in momentum are going to occur before changes in price. And that that price heading up at a constant rate is going to be associated with flat momentum. And that was really the basis of his theory. Now, in order to calculate that, what he looked at, this percent K line, showed C as the most recent closing price. He compared that to a 14-period moving average of the lows of the previous sessions and a 14-period moving average of the highs of the previous session. And all he cared about was that the close on a long move continued to approach the high, and the close on a short move continued to approach the low. As it got closer and closer to the low, to the 14-period moving average low, momentum was increasing. Now, the price of the instrument could continue to fall, but you could see how momentum could then back off because it could start closing a little bit farther away from the low. But the price of the stock is going to continue to drop, but momentum is going to flatten. And here, momentum has the ability to turn. And the percent D was just simply a 3-period moving average of percent K. So in a strongly uptrending market, price is going to close near the high. And in a market trending downward, price is going to close near the low. And with positive momentum, the close of the candle is going to get closer and closer to the high. And on a stock moving down with momentum, it's going to continue to approach the low of the move. And a transactional signal or trade occurred when the percent D crossed through the percent K. That was when he felt it was time to take a trade. Now, you can see how divergence worked here. This is just a slide I pulled out of the internet. Nothing special. But based on his thesis, you can see how price made an equal high, but the velocity, I'm sorry, but the speed with which price approached the high of the candle was not quite so high on this move up. Never got as close to the high as it did on this move up. So momentum turned and is lower. Maximal momentum on this move up was up here. Maximal momentum on this move up here never reached as high as this. And he believed that this would very accurately predict a crash in market price. And he actually, if you look here, you've got, well, this is not really divergence. Now, here's divergence on a chart that I just created in January. Price makes a higher high. Momentum is defined by the oscillator or stochastic, makes an equal high. So price is moving higher, but momentum is not moving higher. And that's going to herald the collapse in price of the stock. So it really makes perfect sense what he was looking at. Now here's a divergence failure. And I could have showed you one that's a lot more dramatic than this, but you can see that momentum is lower, price is higher. The price never the close of the candle never approached the high as strongly as it did here. So you get a lower momentum signal on the oscillator, and then you get a complete collapse right here. And eventually, so you don't get much of a collapse. Price comes down a little bit, And then if you stick with it, it just comes and trends right back up. And I could have shown you a slide where it just completely fails, but it could fail in slow motion as well. You don't really get any major fall here. Hang on one second. So here's how the oscillator should work. Every time the oscillator line crosses below the 80 line, you get a short signal. Every time it comes up and crosses above the 20 line, you get a long signal. So when it goes from oversold and moves out of the oversold area, you move up. This is just an assessment of momentum. Momentum has gone too far. He bounded the indicator. And when it turns and heads up, momentum is rising. This is going to rise. This falls. This is going to fall. Here you get a cross below the 80 line. This is going to fall. Now it all looks great. The problem is why doesn't it work anymore? And here's the answer. Now, all of these indicators, the oscillator, RSI, Williams %K, Williams R, all of them were made to look for divergent signals. They could be used as trend following tools to buy a stock long when it was oversold or to buy a stock short when it was overbought. But the major signal that you wanted to look for on an oscillator was to look for divergence and then fade the market. And the problem now is that is exactly what this slide says. That overbought doesn't mean overbought. And now that you know the association between momentum and the movement of price, which is velocity, you know that this could be rising at a slower pace. And you see here, momentum is peaking and falling, but price continues to rise. So this indicator is consistently failing to call a reversal in price, just as it now consistently fails to call a reversal in price on divergence. I mean, you can trade divergence and it's going to work maybe half the time, sometimes 60% of the time, and sometimes 40% of the time, but it doesn't work consistently. It's not going to work 70 to 80% of the time. And it's been around since 1957, and it hasn't made anybody rich. So it's a signal that you've got to discard from your trading methodology, or ultimately it's going to cost you a lot of money. Now, George Lane and all of the mathematicians who created these indicators were not dumb guys. And you can see that their rationale for creating them was extremely sound. That momentum does change before price, and it is a forward-looking indicator. So there's got to be a reason why it's failing. And I reviewed really why that is. And that is when oscillators were developed, there was little institutional volume in the market, and the power of each buyer was approximately equal to that of each seller. So when you really did get a divergent signal, it really was likely that the market was going to collapse. When you got a short signal in an overbought instrument, there was a good chance it was going to fall. When you got a long entry in an oversold instrument, there was a good chance it was going to go up, because it just ran out of sellers, and buyers are going to come in, look at the price of the stock and consider it to be a bargain and likely take it up. But that's no longer the case, because now, depending upon the market, 60, 70 to 80% can now be dominated by institutional volume. And they skew the market, and they really do decimate a lot of indicator analysis. And this is one that they really do decimate. We can't use it anymore for the reason it was created. And this is what renders RSI, stochastic, Williams percent K, Williams R, antiquated. They were created for the sole purpose of looking for divergence, but divergence no longer works. And you're going to see now, because divergence is no longer an accurate signal, because institutional volume dominates, and institutions are what are going to create the highs of a move and the low of a move. They may pull back a little bit and create a divergence signal, but if they come back in, they're going to run that signal over. So you just cannot trade anymore with the use of divergence. And it renders those indicators obsolete for the reasons they were created. And they were all created, and their math was based on searching for divergence. So in an era of institutional volume, how can you trade the indicator? And I wanted to dispel what I think are now fallacies. And one of those fallacies, and I had to go through this so quickly on the multi-speaker event that I don't know if everybody got these points. And this is why I'm going over it. And I have a lot more slides of the market to show you, which I think will exemplify what I'm talking about. So we have to dispel the notion of overbought or oversold. And I can't tell you how many times in trading in the morning I consider an instrument to be overbought. And crude is one, the NASDAQ is the other, and it just keeps going up. And it goes up on high volume because the institutions are just going to drive it up forever until they're ready to stop. And it's the same thing with an oversold signal. When is that instrument going to stop going down? It's certainly not going to stop. It's certainly not going to stop going down if a divergence signal is created and there's a slight diminution in momentum. It's going to go down when the institutional traders have decided they're finished with it and they back off. Now, so markets are going to reverse at the whim of institutional money. When the computers decide it's time to step away and volume falls, that's when you generally get reversion to the mean. I mean, it still applies, and I see that snap back on crude a lot, and that snap back on the NASDAQ a lot. Once the institutional traders step aside really, and major buying pressure or major selling pressure really does abate, then you generally get a nice pullback, because the reversion to the mean is always going to be a force that's present in the market. You just need to get that major force out of the way to let it evolve. So trading divergence now is tantamount to trading oftentimes against the direction of institutional money. So we can't use an indicator that's looking for divergence, because if we are, it's not going to give us great signals, because the only thing that we can do is use an oscillator that has been formatted to trade in the direction of institutional money. So what we're looking for is an indicator that most accurately assesses increasing buying pressure and increasing selling pressure that completely ignores any potential divergence signal. And with it, you're indirectly going to follow the footprint of big money. The indicator can do that. It's going to give you a nice signal. Now remember, momentum mathematically is always going to lead price. That's never going to change. We just can't use momentum divergence as a signal to counter trend trade. But mathematically, it has to lead price. We just have to take a different approach to how we utilize momentum as a forward-looking tool. Now, the way we do it is the Laguerre. Now, the Laguerre is the most, now RSI, Williams K, Williams R, are all just variations of stochastic. RSI is probably the most complex mathematical formula, but the way it's configured, it still is looking for divergence. It was never made to look to trade the trend. I know there are a lot of traders out there that rely heavily on RSI to determine whether an instrument is going to continue to go up or whether an instrument is going to continue to fall. But this is a better instrument for that. It's got a gamma, which helps determine its sensitivity and specificity. And it's got a number of filters, which allow you to smooth it so that small changes in momentum don't rattle it. Now, the more you smooth it, the more you sacrifice specificity, the more specificity you get, the less sensitivity you get. So there has to be a trade-off. And what we've done is we've optimized the trade-off between sensitivity and specificity, and I believe inserted the best gamma possible. So let me show you some of the entries. Now, and I want to give you the rationale for how we do this. Now, this is the only oscillator, the Laguerre modified, we call it, because it is not an open source code. And if you get a Laguerre in open source, it will not work like this. Is that when the oversold crosses the 20 line, the Laguerre line, it's going to give you an arrow on your chart. Now it's going to print intra-candle, and if the candle actually prints up, the arrow will stay, because the candle, intra-candle, may collapse and close to the downside. But at least you know that if this candle continues to the upside, you're going to get an entry signal based on the Laguerre. And you can see it's really pretty accurate. Now, for us here at Rightline, we're only going to take a long trade above the 50 and a short trade below the 50. Again, acknowledging that institutional money is going to rule above the 50. We only look for bullish trades. And institutional money is going to rule below, and it will push the market below the 50. We only look for bearish trades. So this long Laguerre arrow takes us up. Now, here's how our Laguerre is differentiated from every other. Once the Laguerre line crosses the 80 line, every other oscillator looks to fade the market. What we look to do is we create this green line. And this green line tells us that institutional money is in control of the market. I mean, it's pushed the Laguerre up, and you can see the Laguerre stuck to the top. And when it's stuck to the top, small traders cannot do that. Only big institutional money can do that. So when they move it up and keep it up, if you get a nice long signal on this green band, you can take a trade long. Here's the earliest you can get into the trade, but it may not be a great entry. But once you get the Laguerre locked long, you can take a long trade anywhere here. Now, actually, this is an exit signal when the Laguerre drops below the 80 line. Now, it doesn't drop below the 20, but as soon as this line turns green again, you can go back in long. Now, other traders are going to stay in this trade as long as price stays above support. It's really, I'm not trying to teach you a trading methodology. I'm just trying to teach you how to trade this signal. You can move out of it here. Now, this is not a small move up. This is a 30-minute. So you're going to get, if you enter here, this is pretty decent profit. And if you exit here, you've still made nice money. But once you go green here, you can then continue to trade the instrument long. Here, you can only go long. So what we're doing is to stay with the market and to stay with the direction of institutional money and never fade it. And now everyone asks, can you trade it on different time frames? Can you trade it on stocks? Here's a 30-minute of the Qs. And here's a 60-minute of the Qs. And I really like the 60-minute. Now here's a short Laguerre arrow. You see it crosses below the 80 line. Now this may be, based on your trading methodology, the best place to take a short. I wouldn't have taken it here because I'm still sitting above the 15. I would wait for the break, or I would wait for the indicator to lock short. And once it locks short, price is just going to fall. When it goes here into sideways price action, most other indicators Oscillator are going to take you out of the trade. And we're going to compare them in a little bit. But the Laguerre is going to lock short because that's what it was made to do. It wasn't made to be influenced by sideways price movement. It remains flat, keeps you in the trade short. It's a great tool following the flow of institutional money. Here's a Laguerre arrow long, and that's a great long signal. Now this is on a daily chart. Then this is a terrific trade. Now you get 2 times where the Laguerre just drops below the 80 line. You can exit here if you want. You can exit here if you want, or you can exit on a break of support. It's really based on your risk tolerance. But this is a tremendous entry and a very profitable one because these are daily bars. Now here's a short trade right here. The Laguerre is crossing across the 80 line. You don't have to look at the Laguerre because you've got the arrow. You're below the 50 and the 15, and down you go all the way. And this single up candle doesn't even budge the Laguerre from solid red. Now, we don't take counter trend signals. Remember, we never trade long below the 50. Although this trade would have worked, you had a really big stop. Here's our next trade, short. We don't take counter trend. We don't take counter trend. And the short trade goes all the way down. So we're using the oscillator in a completely different way because it's formatted differently. And what it's formatted to do is track the direction of institutional money. And remember, since it's momentum based, it does have forward-looking ability. Now, here's where we're going to do a little comparing. Here is stochastic. Now, stochastic gets you in earlier. Here's the cross of the Laguerre line across the 80 line. It gets you in right here, and that's an entry. But you can see right here, stochastic looking for divergence. It's not looking to keep you in a trend trade. Just comes right up above the 20 line, takes you out. The Laguerre is locked down and stays down. So you're not going to get shaken out of this trade. And if you use this as a tool, you just keep going lower and lower and lower and lower. Now this is a little more complex setup. I may have shown this before, but again, only trend trades. Here's the Laguerre when it's oversold. Get a long signal right here, long. No counter trend. Here's where you're locked long. You could have taken that long right here. Here you're locked long. And you've got a nice pullback and continuation. Here's divergence. On stochastic, this is RSI, and it goes nowhere because the institutional money is against you on this trade. Can't trade divergence. You've got to trade in the direction of money flow. And the Laguerre, harnessing momentum, is telling you to go long. And here's another long trade right here. So in this area, you got one winner, two winners, three winners. And if you traded divergence, you'd have one big loser based on the RSI. Now here is Williams K. I think I might have shown this again before. Same thing. Takes you right out of the trade here. Takes you out here. But the Laguerre locked long. You're not going to exit. You've got no down arrows. As long as this is locked long, you stay long. Because it's configured differently. But it's still at its heart and at its core, it's using change in velocity of price or momentum to make its assessment, just like Williams K is. Here's another QQQ 30-minute. I mean, this is a stellar trade on a 30-minute chart. And it never gives you a down signal. It's locked long for the entire move. And you're never going to exit. Here's your first, right here, and down. So you get a great signal. Now, I wanted to use the QQQ as a proxy for stocks. If it'll do it on the QQQ, it'll do it on any stock. I showed you a QQQ 30-minute, 60-minute, and daily. Doesn't matter what stock you trade. And it doesn't matter what time frame you trade. It doesn't matter what kind of bar you trade. These are candlesticks. You can trade time. This is time. You can trade tick. You can trade Unorenco. It does not matter. The only thing that I warn you about is you cannot trade Renko, because remember the four parameters that are required in order to determine momentum. You've got to know the high of a candle and the low of a candle, and you've got to know the open of the candle and the close of the candle. Because at its heart, the core of the analysis is how far is the close off the high on a long, and how far is the close off a low on a short. And Renko bricks do not show that. And there's very, very expensive software out there. In fact, one uses a Laguerre with no wicks and no oscillator. Will work if there is not an open high-low close. You put it on a Renko chart, it's just going to trace out price. You're going to get a line that fails. You know, occasionally I go into that room and I see them chasing that Laguerre, and all I see is if price goes up, the Laguerre goes up. Price goes down, the Laguerre goes down. It's just a roadmap. You can see here how price doesn't mimic, how the Laguerre line doesn't mimic price. You get this consolidation here, but the Laguerre stays fixed, overbought. It is not going to get shaken out by consolidation. And even on this big pullback, it only gives it a blip, never takes it out of overbought. Here's a QQQ 60-minute. And I think I might have shown this already. And here's the daily. I think I showed this too. Now, this is a Unorenco, which is what we trade. And you can see these great long signals. You see how it blipped here? So it gave you two. Either long signal was tradable. And once you lock long here, you just continue to stay in this trade. And you didn't get a short signal till right here. And that's where you exit. And you got another short signal right here. And it's evolving. And that's going to get you a first target. Now, I'm just going to skip this because it's two big moves. It's an 86 tick move down and a 12 tick move up. Now, what else did I want to show you? I know there was something else. I'm trying to remember what it was. Oh, I know. What I'm going to do is I'm just going to answer questions now. Because hopefully I've gone into this with enough depth. But let me show you a. So I really want you to understand this. Whether you purchase the indicator or you don't, I don't want you to get flipped or have trouble trading. I want to try to make you a better trader. Let me take that out. Send for you. Now it's a really complicated chart because it's got the Laguerre, it's got stochastic, RSI, and Williams R. It's got 4 indicators at the same time. And if you look at all of them right here, they just do not perform nearly as well as the Laguerre. When the Laguerre is locked short, like this, it's locked red, you've got in the bag all the way down, just like that. And it's oversold throughout the entire move. Stochastic bumps you right out of the trade. RSI never even gets you in the trade. Williams R bumps you right out of the trade. So they're very, very difficult to trade because they weren't formatted to do what we're trying to do. And if you take this trade short right here, you get no signal on the stochastic, no signal on Williams, on the RSI, no signal on Williams R, perfect signal on the Laguerre short. Now, it's not going to go very far because you don't really get a signal to exit on the Laguerre. It's telling you to stay in this trade all the way. It goes down, goes to oversold, locks short, and stays short. So even though you get 3 candles up and 2 candles up, the Laguerre stays red, it locks red, heads down, locks red, and keeps you in this trade all the way. That's what we intended it to do. These other indicators, I mean, you are out. You're never in, and you are out. And I could do that ad infinitum for you, really. I mean, here's another trade I actually marked. Here's a short trade. And you get a nice stochastic entry here. And the stochastic here works well. RSI doesn't give you an entry. And this one, Williams K, does as well. Because this is just a straight down move. So they're about equal there. Just looking for a trend trade because we don't count a trend trade. And I'm actually at the end here. And I don't think we have another trade that I can show you on this chart here. But I think you see what I'm talking about. Here's a long trade right here. Now, stochastic, you don't have the trade. RSI, no trade. Williams R, no trade. Here you have an arrow. You go up. No signal to leave on this pullback. In fact, you're locked long on this pullback, and you go all the way up. Here's the arrow that takes you out. It's not a huge move, but it's a winner. On these oscillators, you have no entries at all. So it deprives you of a winning trade because it's looking for divergence, and we are not harnessing momentum. So let me answer any questions you have. I'll show you our offer. It's the same as it was before. And you still have a couple of days to do it. Let me just bring them over. Hold on one second. Now this 10 has been modified. We've had a lot of orders. I didn't change it because I haven't asked Rory how many we got, but we've gotten quite a few. So I don't know how many get it, But if you're one of the first, whatever, you're going to get a month in the live trading room with me. And it's $299 for a lifetime license. You get all free upgrades. We have a Thinkorswim version that you can put directly onto Thinkorswim. We have a great video that shows you how to do it and create a Thinkorswim template with the Laguerre in it. And the Laguerre on Thinkorswim is beautiful. And this is the purchase link, but we'll send you an email too. It's www.rightlinetrading.com/modified Laguerre. And the offer expires on Saturday night. So let me see if you have any questions. It really is a terrific indicator. I always get screamed at by everybody in the office when I show you a full workspace that includes everything we trade, but we do not trade against the direction of the Laguerre. And it really helps us stay out of chop. And let me show you a Laguerre signal and see how great it is. Now, you're not going to get everything on here, just going to get the Laguerre. But down here is the Laguerre. And see here when it locks red? It's the lower line. All you have is short bias all through this move. Now, you see here, that's the down arrow right here. Now, you can't take it short here because we have a pivot. We go short right here on the pivot breaker, and you're locked red, and down you go. We're not looking for divergence. We're looking to trade in the direction of institutional money. And let me tell you, this Laguerre is tracking it. That's the whole platform. All you're going to get is the Laguerre. So I don't want, and I'm recording it, I don't want anyone to call us and think they're going to get the whole thing. But I want you to see on a live chart how helpful it is to trade. When you get the down arrow, you get permission. When you get it locked down in red, you're really desperately looking for a short entry. Now, it's just giving you an absolute direction, and you can't always get in short. Sometimes you don't get a pullback to enter a short trade, but you look for one, and you know you're not going long on divergence. We're taking momentum to the downside, and momentum, as assessed by the Laguerre, is continuing to accelerate to keep that line locked down. Once that line comes up, that's when momentum moves to the upside. And if you take the arrow out, you're out pretty soon, and you get 75 to 80% of the move. Never going to get 100%. So let me see if there's any questions that I can answer. Man, if I could, like I said, if I could call a bottom or a top, I would be in Tahiti. There's no software. I just want to qualify. Just want to say one more thing. If you listen to people who claim their software predicts tops and bottoms, run. Because like I told you, the only way to predict a top or a bottom is to know what the institutions are going to do. There is no software that can. The only thing software can do is track the flow of institutional money. It can't tell you when it's going to go on and when it's going to go off. And you simply can't call a top or call a bottom when you're day trading or swing trading. And I'm telling you, I see price go through double pivots. I see it go through market profile, value area highs. It's going to go through everything as long as the institutional traders are going to continue to push it up. So let me see if there are any questions. Hang on one sec. I mean, I used to look at double tops off of resistance or off support, and let me tell you, they just fail to. No, mass is not volume. In that formula, let me look at that formula. Hold on a minute. I don't know where I put it. But obviously mass, a force equals mass times acceleration. But I didn't want to look at force, Shy. I wanted to look at momentum. And momentum is a force component. But to calculate momentum, you got to look at speed, and the change in rate and speed, or velocity. Actually, in mathematics, it's called velocity. Okay, Michael. When price over time, there is velocity, correct, and acceleration. Technically, you're correct. There is no mass. What we call momentum is really acceleration. You're absolutely correct, Michael. Very smart. And Michael really has it right. And really, I'm going to read you what he said, because he really clarified a little bit about what I said. And that is what we call momentum is really acceleration. And that is the second order derivation of velocity. So, and I'll just tell you this, Michael, I called it momentum because you're absolutely correct, only because as traders, we look upon an instrument to have momentum. We don't really look upon it as really acceleration, deceleration. So I just wanted to put it more in traders' terms, but you put it in more in the terms of a mathematics, physics type way, and you are 100,000% correct, by the way. Hey guys. Okay, Madison, Wisconsin, Mark. Don't get frozen up there. Remember, no instrument can track institutional volume directly. It's impossible. It simply uses momentum, or as you pointed out, velocity, or it simply uses acceleration as a proxy of institutional money. Only institutional money can create the continued acceleration of a stock, of a forex pair, of a future. I mean, small traders can't do that. Small traders can't take the Laguerre, lock it short, and keep it short by continuing to increase momentum. So it's not a direct association of it doesn't directly track more institutional money, but it's showing us what institutional money is doing. That's all we can do. We can't do more than that. When it's locked short or locked short red or locked up green, you can be pretty sure it's the institutional guys that have locked it there. Larry, we're still thinking about doing it. We were thinking of making the Laguerre a multi-time frame instrument, and we still may wind up doing that to give it a little more forward-looking ability, Larry. Keith's workspace already has it. So it would be a very small step for us. And if you have the indicator, you would get that upgrade. Scott, we get tons of setups. I'm telling you, on the E-mini and the NQ, we get, well, first of all, I trade the NQ and I trade crude. Crude can go 2 or 3 days without a setup. The NQ gives us a lot of setups. What you really have to do is be able to be able to filter the losers. I mean, the NQ is not an easy instrument to trade, but if you can bag and tag one. I mean, today I was sick. I got the flu from my son. And it was one of the rare days I couldn't trade. But Tuesday, we had 3 NASDAQ trades, one for 9 points, one for 9.25 points, and one for 6.25 points. Everybody in the room knows I'm telling you the truth. So you can get very big NQ moves if you keep and if you stay with the trade in the direction of the Laguerre lock. John, I like to use Unorenko. Unorenko, in a sense, give us candlesticks. And if you'll notice here, we created hybrid candles. You get the wicks inside. We can see the wick. And I don't know, we may be, right now, I don't know anyone else who does it. We have not invented this because traders in our room tell us that they've seen it before, but we get to see inside. And the only reason this works, now we're going to have to give you the Unorenko hybrids, and Rory's going to have a fit, but we need to give you the wicks. Because if you don't have the wick, this won't work. So you're going to get that inner wick if you choose to use Unorenko. Anything else will automatically give you the wick. So the kind of candle is really up to you. You're going to get, I showed you 30-minute, a 60-minute. I showed you a daily. Those are really irrelevant. And if an indicator is time dependent or instrument dependent, it doesn't work. It either harnesses the forces accurately or it doesn't. It's either tracking correctly or it doesn't. So if somebody tells you, well, it only works on a 450 tick of the NQ, run. Somebody tells you it only trades stocks, run. Because if it's really looking at a force that moves price, it'll move it on any time frame, on any type of candle, and on any trading instrument. It's got to be the way it is if it's really working appropriately. On PAM, it's not compatible with Sierra. We have a Sierra platform, but we need a long way to go to upgrade it. What you can do, if you like, is you can trade it off of a demo version of Ninja, and that would be, and it wouldn't cost you anything. I mean, you can get a demo data feed, which will track it just like it would a live. And you're just going to have to run a small Ninja demo chart to the side, and you can take the signals right off of Sierra. That's the best we can do. And we do have a good Sierra workspace, but a lot of these indicators are missing because we need time to bring it up to date. Thank you so much, Leonard. Leonard says he loves my program. Your team has done a great job. Well, Leonard, doing an assessment of the hybrid candles is not something I want to do in this webinar because it's really only meant to look at the Laguerre. And if I do that, it's going to take it in a direction I really don't want to go. We're right at an hour, and we're still going to go in probably another 10 minutes. So bring the question up to me, and I'll answer it for you in the trading room. Be more than happy to. Yes, Vincent. Every entry hour, I don't show stuff that doesn't appear on your charts. Every arrow you see here appears on your charts when you trade it. And the benefit of the arrow is that it doesn't just print when the candle closes, it's going to flicker intra-candle. So you know that if this candle closes to the upside and closes to the upside, this will print and stay, and you're in. So when you see the flickering, all you do is you put your buy stop one tick above the close of the candle and have it waiting. And let's say the candle decides, I'm not going to close up. I'm going to collapse. It's going to cancel your trade, or you just cancel your trade. You can't get burnt. Now, every time an arrow prints, it never leaves. Nothing repaints. But intra-candle, it may flicker, and then if the candle collapses on you, it'll leave because it's just a heads up. But once you get them here, they stay, and all of these are printed. I didn't put them up there. I'm not, I don't have the patience to put those arrows up there. It would have taken me 3 weeks. John, I'm 99% sure we'll make it a multi-time frame tool. I really am. It'll take Sergio a little bit of time to get to it because he wants to finish the NDT and all that stuff. But I always like multi-time frame assessments. It's just, and right now the Laguerre is the only indicator we have that's not multi-time frame. And I'm pretty sure we will do it. Okay, Rod, the yellow line on the Laguerre, that's a really good question. What I'm going to do here is I'm going to take out all the other stuff. So I can really show you the that yellow line. Now, the yellow line is really pretty good. I don't really use it in an assessment of a trade, but what that yellow line is called fractal energy, and really it's a really fancy word for an assessment of volatility. So it's making a volatility assessment. So where do you get the signal? You get the long signal here. It's not a great signal. And what you're really going to have to do, I mean, you're not going to enter on this candle. Remember, you need to enter on a pullback. You just can't take a signal blindly. What you're going to do is you're going to wait for this candle. The market moves up, and then it pulls back. And then you take this trade long. Right here, I'm telling you, I'd be on this candle because the Laguerre's locked long. Now, if you look at the yellow is sort of giving you an assessment of volatility and telling you, it's giving you a rough estimate of how far this move would go. So if the line rises into your trade, it's sort of giving you a little bit, see how the line jumps here? It gives you this little peak. It tells you that volatility right here has made a spike, and you can maybe anticipate a bigger move to the downside. It's only a rough estimate. I don't really use it to change my stops, but I do like it if I see that yellow line rising into my entry. If I see it falling into my entry, I'm still taking the trade. But that's what that yellow line is. It's a volatility measurement, and for some reason, Laguerre calls it fractal energy. Scott, it's available on NT7 and NT8 right now. That's it. You know, we're working to put it on other platforms, but you can trade it on a demo without any cost and take the signals on your live platform. Now, if you trade Think or Swim, we have it. We have it on TOS. Forgot to tell you that. The shortest time frame, Clayton, it depends upon the instrument. Remember, if you're trading bonds is has very low volatility. Bonds and notes. I mean, if you want to trade a 1 minute, you can trade a 1 minute. I mean, we trade in Unarenco, we trade a 411. Crude is a 5210. So you can trade there's no absolute. I mean, you could trade a 30-second. I don't think this will do anything less than a minute, but you can trade a very fast chart on Treasury bonds and Treasury notes. It's almost a hypothetical question because you can really trade a very fast chart. If you trade a tick chart, Clayton, you trade a 10 tick. The thing's going to move at 1,000 miles an hour. You really got to tailor it to the volatility of your instrument. Okay, John. Everything that we show here is right lines. Everything. Now, this chart is what you're going to get. Now, you're not going to get the 50 and the 15. You're just buying one indicator. I want you to know that. The thing that you're going to get is you're going to get the wicks inside the candles. So the oscillator will work. This is just my 50 and my 15. You can put any area of support. I mean, you can put it, you don't need it, but this is just my trading methodology. And I'm not trying to teach you a methodology. I only go short below the 50 and I only go long above the 50. And for me, the best trades are when the 15, long is when the 15 is above, and the best trades are when the 50 is red and the 15 is below. But that's my methodology. This is not a talk or an assessment of trading methodology. See, look at this trade. I mean, it's unbelievable. I mean, I hate to say gimmies, but that's a gimme trade. I mean, you get one of those and you're done for the day. I mean, you know, this is probably a crude inventory. No, it's not. It's at 10 o'clock. Crude inventory is at 10:30. I mean, this signals a perfect entry, and you're not going to get out. Now, maximum excursion is 89 ticks, but if you exit here, you're going to get 73 ticks. That's a heck of a move. So you don't get the 50 and the 15, but you get the hybrid Unorenko candles if you trade Unorenko, and you get the oscillator, which includes the arrows. So I want to be very, very careful. I don't want to disappoint anybody. That's the best. That is by far and away, sir, the best. 14 is the best. It's always correct. It came with a 14. That's the external input. We tried all different numbers, and that is by far and away the best number. So just keep it right there. When you get to Laguerre, you do not have to change anything on it. You know, it really, Shuv, it totally depends on your goals. I mean, I'm a day trader. So obviously I trade a short-term chart. If you want to swing trade, you can trade 2-hour bars, 4-hour bars, daily bars. This is going to give you the same signals. I mean, if I covered up the size of this speed, well, if I went to a different candle, I mean, I showed you a lot of trades on 2-hour, 4-hour, daily. You wouldn't know what instrument it was. It doesn't make any difference. I mean, it all depends upon whether you want a few entries that go far or you want more entries, whether you're a day trader or a swing trader or a really long-term hold. I mean, we have traders who trade this on daily bars. So they're not going to get many signals, but when they get in, they can hold the trade for a week to 10 days. So it's really up to you. Hey, from Wisconsin, Jeff. Hey, Jeff. You know, John, we took all of those values and internalized them, and I don't know anymore. I really don't. You've got a different Laguerre than I do. And a lot of the Laguerres and open source are honestly, if you put them up against this, they're going to trade differently because you've got multiple filters and you've got that gamma. I really can't give you the best number. I don't know what the gamma is of your Laguerre. I know what the gamma is of mine. So without knowing that, and you can't see it, because that's usually buried, I really couldn't. I don't want to give you misinformation, John. That's the problem. Oh, for sure, Rod. A 5 to 10 minute chart, absolutely. Yeah, for sure. I mean, I think I showed you slides where it was on a 30-minute. It'll definitely work on a 5 to 10 minute. Hey, my pleasure, Leonard. You know, Scott, it doesn't make any difference whether the instrument is low volatility or high volatility. I think the Laguerre is going to work it's going to work on all of them. I mean, really. I mean, the E-mini lately has been lousy to trade, and it's exemplified by the Laguerre. And I can show it to you really quickly here. It's not been a great chart, and I just have to change the inputs here. This is 428. And we have all the inputs if you want to trade Unarenko. Give it a chance. And you can see it's choppy, but the Laguerre's tracking it all the way up, and it's smooth. Now, there's a long arrow, and there's a trade. Small, not a big one. Now, it's calling a reversal here. I mean, the E-mini has just been a lousy instrument to trade, and there have not been many entries on it. I have to tell you. It's just been choppy as heck. So you see, here's a great signal right here, a great short entry. So early in the morning, once you stay in, it locks red and keeps you in. That's what we want. There's just not that many signals. And there's another great trade right here. And you see the Laguerre on this 2 candles up, stays red. I guarantee you all the other oscillators are going to take you out of this trade. It bumps a little, but not enough. And it stays, and down you go. And then when it makes, but it takes you out quick. Right here. It doesn't leave you, so it exits you. It's going to give you an up arrow here. Your up arrow to take you out is all the way here. So once momentum really does wane, the signal comes in fast. And if you entered here and exited here, you got yourself 5 3/4 points, which on the E-mini right now is a great trade. John, you can use the average true range for stop. I choose not to. I always take myself out on a reversal candle. I'm a little bit. I'm very timid, and I'll tell you what I would do here. But again, we're good looking at trading methodology. Is I would take myself out and I would go right back in, and I would just. So I would unfortunately break this into 1 winner and then 2 winners right here. And you can see it may give me even better money because I don't have to take this long trade. I'm out on just 1 reversal, but I'm not going to take this 3rd trade down. I'm going to go in here and I'm going to go in here, but always in the direction of Laguerre. I mean, that is pointing me. And if I get a pullback and then a continuation trade in the direction of the locked Laguerre, every other oscillator trader is looking for the counter trend. We're saying that institutional money is locking it short because velocity is continuing to increase here. And so we're going down. The further enhancement, Vincent, is right now it's just assessing price off of our trading chart. We're going to make it a multi-time frame assessment. Dr. Keith is already using it on his workspace. So to transfer it here, it's really small. Thank you, Rod. This is a 50 EMA of a 50 EMA. It's our own creation. And this is a 15 EMA of a 15 EMA. And what this does is it gives you the speed of an EMA and the stability of an SMA. It's really remarkable. But I don't want to go into that too because it's getting offline. But I love these 2 moving averages. My pleasure, Carl. Yeah, listen, MACD is the same thing. Absolutely. MACD works the same way. You can see how traders back in the 50s we're looking to create, Carl brings up MACD, which is a momentum assessment indicator. They saw mathematically that momentum-led price and MACD and stochastic were born. But now we know that MACD crossovers don't work. MACD divergence doesn't work. Oscillator divergence doesn't work. So the thing, Carl, is that MACD was always created as a trend following tool. That crossover was a signal to continue to take the trade long or short. The oscillator was never meant to be a trend following tool. George Lane, who created it, meant it to be a divergence trading instrument. What are the pluses? I don't see any, John. Oh, the asterisks. I don't see any of those either. There really aren't any here, John. You're not going to get any of those. Thank you so much, Mark. Thank you, John. Here's today's. I'll show you today's ES. I didn't trade today, so I do not know what the ES did, and we'll look at it together for the first time. Let's go back right here. Here's the open, right here. Now, here's your first trade on the ES, right here. The Laguerre's lock short. And there's your first trade. Here is going to be your exit, or you're going to exit on a reversal. You have no re-entry here. No re-entry. Here, you've got yourself an entry. You don't have much here, though. This is not going very far. I mean, that's the E-mini. I mean, you'd have to have a really small target here. So you have a winner, and you probably have a loser. And I'm going to be the last person to tell you this thing is foolproof. Now, here's your short trade right here. And look at that trade. Keeps you in all the way. So this is your killer trade for the day. Right here. And you have, that's 11.25 points. If you exit on the up candle, just go right back in and take it the rest of the way down. Exit on the next up candle. Or if you take it all the way, you're out here. That's a great move. Now here the market's getting very choppy. And if you're going to trade this, you just got to hang with the Laguerre. And you got yourself a really nice short trade here. All these up candles don't do anything to it. It is locked. It is pasted to the floor like glue. And down you go. There's your short signal. And there's a winner. There's your short signal. There's a winner. There's your short signal. There's a winner. That's it. Well, that's 12 o'clock. Now here's a long signal. Here's a winner. We don't take counter trend. And now I'm not, let me tell you, I'm not alibiing, but I'm just telling you, with all these winners, you're done. I mean, I had a winner here, a winner here. Now you're going to pull in a loser. Yeah, it looks to me like you're going to pull in a couple of losers, but your winners are gigantic. I mean, if you monetize these trades, you blow the losers away. And they're right here. So it's not foolproof, but 8 out of 10 signals will work as long as you trade short below and long above on Eastern time. So that's accurate. I didn't give an entry signal before 9:30 Eastern. Okay, well, that's it. Listen, everyone, have a really, really great evening. At the very least, I hope you understand how the market's evolved, how it's changed. Hey, thank you so much, Eddie. Thank you. I appreciate that. That's what I'm trying to do. I mean, a lot of traders are looking for good information. Thank you so much, Rod. And I'm trying to, at the very least, even if you don't come aboard, at least you leave with a lot better understanding of what we're trying to do and how we can utilize tools to trade the market as it is today. And I'll just leave with this. Institutional volume is going to become a bigger and bigger problem as we move forward, not a smaller problem. So if we don't trade using indicators that indirectly track its direction, we're just going to get hurt more and more and more. So this is the methodology we have to use. Every tool we trade with has to indirectly, it's called follow the footsteps of big money, because it rules the market now, and it is going to rule the market even more as time passes. So listen, okay, let me see, John. Hey, thank you so much, John. Everyone have a great evening. Best of luck to you guys. We're all the small guys. We got to trade with these big giants, or we're going to get crushed like little bugs. Who says like the flea that you are? Oh, Mr. Wonderful on Shark Tank. He says they will crush you like the roach that you are. Well, we have to trade with these guys. Hey guys, thank you, Richard. Really appreciate it. Take care. Have a great evening. Any questions, feel free to give me a call. Let me just give you our number really quick. It's right here. It's 786-713-5276. Rory's here for a while. You're welcome to give us a call, or you can call us tomorrow. Have a great evening, everybody, and good luck. Best of luck. I want you guys to make money. Take care all. Bye-bye.